Australia's superannuation rules are changing, specifically for those with high balance accounts. It's Division 296, a new 30% tax on earnings over 3 million and 40% over 10 million. But the biggest story isn't the tax itself, it's what the government decided not to tax. And this new tax bill will not go to your fund, it will be sent directly to you. We'll break down the final rules, the critical dates, and the strategic actions you can take now. So, who is actually targeted by this tax? The government states it's less than 0.5% of all super accounts. But this isn't a tax on your total balance. So how will the ATO calculate and collect it from you personally? First, the timeline. You have time to plan. These new rules do not begin until July 1st, 2026. The first key date is even later. The ATO will measure your super balance on June 30th, 2027. This is not a cap. You can grow your super beyond $3 million. This only reduces the tax concession on earnings. To prevent bracket creep, the thresholds are not fixed. Both the $3 million and $10 million figures will be indexed to inflation. Now for the most critical detail. The initial plan was to tax paper or unrealized gains, a major point of concern. That was scrapped. The tax now applies only to realized earnings, interest, dividends, rent, and realized capital gains. Understanding this realized gains rule is key to the next part, how the tax is actually paid by you. The ATO will issue a separate tax notice directly to you. You can pay from your pocket or withdraw it from your super. To ensure fairness, this is not just for SMSFs. The design now includes defined benefit schemes for consistency. The government's stated rationale is equity, positioning super for retirement, not as a tax shelter for a small minority. Let's make this real. For an SMSF trustee, the timing of when you sell a property or stock now directly impacts your personal tax. This creates a strategic window, selling an asset before none. July 1st, 2026 means the gain is taxed under the old rules. Consider someone near retirement in 2027. Managing drawdowns to keep their balance under the threshold could defer the tax. These examples show planning is now central, but the system has other nuances we must consider. A common mistake is thinking a pension account provides an escape. It does not. Your total super balance includes it all. For younger members, the index threshold is a moving target. Asset allocation must account for future tax cash flow. And the earnings calculation is not simple. It's based on the change in your total balance, adjusted for contributions. For defined benefit members, it gets harder. Valuation methods are still being finalized to ensure consistent treatment. So we have the rules, the dates, and the finer points. What is the single most important takeaway from all of this? It's this. The shift to taxing realized gains only, combined with the tax being levied personally, changes everything. Your decision on when to sell an asset inside SuperNow directly determines your personal tax liability for that year. This is why, as we saw, the period before June 30th, 2026 is so significant. It's the last window under the old system. June 30th, 2027 is not just a date, it's the finish line for the first year of strategic balance management. Division 296 is more than a tax. It's a fundamental shift in managing high balance super. It puts control with the individual. The key takeaway is control. You now directly influence this tax through your decisions on sales, withdrawals, and contributions. Therefore, the first step is a full review of your super assets. Model the impact of realizing gains before or after the deadline. The details are substantial and the stakes are high. Speaking with a financial advisor who understands these rules is vital. Division 296 marks a new era for superannuation planning, one defined by personal responsibility and strategic foresight.